The last thing we want to consider is the fact that with our income statement, we have the ability to do a cash income statement or an accrual income statement. So let's compare those two to kind of finish off our talk on income statements. We have the option, and we're going to just look at what the benefits are to each of those. Cash accounting simply, it means that I'm going to recognize revenue when I've actually got the cash or I've received it. Somebody wrote me the check, I was able to deposit it. That's revenue to me. And my expenses are those when I have actually paid them. So I've actually, again, written the check, I've paid for that bill. It's not something I've charged at the feed store, it's actually paid for. So whenever we think about cash accounting, we recognize revenue when it's received and expenses when they are paid. So the big reason that a lot of people use cash accounting, the hugest advantages, is basically the fact that it is very simple to use. It's like running your check register on your checking account. So if you keep your check register on your checking account, then that's cash accounting, because all you're doing is writing down when your deposits are and when your checks are. And so that's basically all that is. It's very simple and easy to use, and the other thing that we use it for in terms of advantages is the fact that if I want to make some adjustments to how much money I made for an income tax purpose, I have that ability. I have the ability to make some manipulations. In other words, maybe I go ahead and send a check at the end of December for a bunch of prepaid expenses, because that will give me more expense and reduce my net farm income and give me less taxes to pay. Even though those prepaid expenses are not something that's part of this year's operating part of the business, it's really for next year. So on a cash basis, it would show up, it would help me from a tax standpoint, it'd show up as an expense, it would reduce my net farm income. But on the other hand, it's not really that accurate, because maybe those expenses weren't really for this year. So when we think about the disadvantages to using cash accounting, a lot of times the estimated profit may not be truly accurate. It may not really represent the profit from this year's production. Again, if I pay, let's say I pay the chemical bill, the fuel bill, and the fertilizer bill, and the seed bill. Let's pay all four of those. We paid a whole bunch of those, and we prepaid them in December, but they're really not going to get used until next year during 2020. So 2019, in December of 2019, I made all these prepaid expenses. That's great. That might have helped me from an expense standpoint, reduce my net farm income for taxes. But then that's not really expenses for 2019. Those are 2020 expenses. So it's not as accurate. Accrual on the accounting, on the other hand, does the opposite. It basically looks at revenue as only when it's earned and expenses when they are incurred. So in other words, if I went and I did some custom work for another farmer, he hasn't paid me yet. On cash accounting, I don't show it as revenue because I haven't received the actual cash yet. Under accrual accounting, I would show that as an accounts receivable. The person that I did the custom work for owes me, and they will be paying me in the next maybe 30, 60, 90 days. They're going to be paying me. So it's an accounts receivable for me. It's something where someone's going to be paying me. I've earned the income, I just haven't gotten the cash yet. Same way with expenses. If I go charge things on account, if I go into the feed store, charge the feed, I'm going to wait for them to send me my bill, and then I'm going to go ahead and pay them. That's an accounts payable for me. But that means that on an accrual basis, I need to show that that's actually an expense when I do it. When I go pick up the feed, it's an expense. Not when I send the check later. Maybe that's 45 days later when I send the check. So we recognize it when it's earned for revenues and when it is incurred for expenses. So obviously you can see that it is going to be a more accurate picture of really what our net farm income is if we do it that way. So if I do go get feed and charge it, it has now become an expense to me. If I go do something and they haven't paid me yet and I have an accounts receivable, that's income that's been earned. I get to show that as income. So my picture of my net farm income is going to be more accurate. I'm going to be able to adjust for changes in inventory. A lot of times what we see producers will do is we might hold off selling a product, especially if we're towards the end of the year, If we already have enough income for the year and we don't want to have additional income from a tax standpoint, then we might hold, maybe there's some grain still in the bin, maybe there's some hay that we haven't sold yet, we intend to sell it later. Those kinds of things will happen, and as those things happen, from a cash standpoint, then it's not sold yet, so we don't include it. From an accrual standpoint, we would show that we earned the income on that grain or that hay that's in inventory. We would show that as income. And so it's a better picture. It's more accurate for us. On the flip side of that, in terms of a disadvantage, is it does take longer. You've got to have everything in inventory. You've got to keep track of it. So the time and knowledge required is going to be higher. And it does not let you make more manipulations from a tax standpoint. It doesn't really let you do that quite so much. So here's what we're going to